Right. Good evening, everyone, and thank you for taking the time to come and hear me. I can always tell the level of anxiety in the markets by the number of registrants for this quarterly webinar. And today is not the highest, but it's amongst the highest. And I think that the AI question resonates with all of you. So I hope to address that. Yesterday, my colleague Shmuel Ben-Ari hosted a webinar in Hebrew with a little bit more of a deeper dive into the local market. For those of you who understand Hebrew, you're welcome to watch a recording of that. Okay, the format I'm going to follow today is I'm going to review the indices because that's what affects your portfolio performance at the end of the day. The more equity orientated you are, your performance will be closer to those numbers. The more bond orientated you are, your performance will be closer to those numbers. So, and then I'm going to keep bringing in the AI. Is there a bubble in AI question? And it's a good question, right? And you know the definition of a good question is the ones that are difficult to answer. So I'm going to present some evidence to give you comfort. I'm going to present some evidence which might show areas of concern. And I think because of that, we need to revisit some market fundamentals. We need to be reminded that the market continues to go up and down and trend up over time. So I think market fundamentals are important, but I'm going to mainly focus around the AI issue. Then I'm going to do a little high-level economic summary of the issues that concern me, and then a short summary of what's happening in the Israeli market, and then we'll finish with some questions. Hopefully it'll be 45 minutes, and I hope you enjoy. Thank you, everyone, for coming back, and welcome to the people who are hearing this for the first time. All right, let's get going. Firstly, this is the major indices, S&P 500, 10%. That's for the 6 months ended June, so that's 20% annualized. Pretty strong. A lot of that's coming from the AI companies. We'll talk about that in a minute. Last 3 years, 75% on the S&P 500. NASDAQ, 20% in the 6 months. That's 40% annualized. Very strong. 103% over the last 3 years. You expect the NASDAQ to do better than the S&P over time, but it is riskier. MSCI World, very similar to the S&P, both on a 6-month and 3-year basis. Normally, the S&P does better than the MSCI World, but of late, they're very similar. Tel Aviv had a very strong start to the year, gave back some performance in June, but still has outperformed both the S&P, the NASDAQ, also the MSCI World, at 124% return on the Tel Aviv 125 over the last 3 years, and that is in shekels. So if you do that in dollars, it's an even higher number. MSCI China is down 14%, and it's only 23% return for the last 3 years. 10 years ago, I liked investing in China, and then about 5 years ago, we realized that the economic miracle of China was not flowing through to foreign shareholders. So we sold our position in China 5 years ago, and I'm very happy about that. Bonds have done their job providing ballast. You don't buy bonds for growth. You buy equities for growth. You buy bonds to provide ballast when the market wobbles come. And when there's a war going on, a lot of conservative investors were very happy to be holding bonds, even though they didn't produce great returns. So we collected our coupon for 6 months. Interest rates went slightly up, and therefore you got a small capital loss. So bonds are pretty flat, both treasury and investment grade. Israeli bonds did much better, 2.8% for the 6 months, which is pretty much in line with expectation. And they've done better than their global peers over the last 3 years at 18%. Okay, now we're going to get a little bit more interesting. So I've included in this list the SOX. SOX is one of the two main semiconductor indices, okay, and which is obviously benefiting from the AI story. So year to date, January to June, the SOX index is up 113%. Over the last 3 years, 283%. Big numbers. Please compare the broad index, the S&P 500, the general tech index, compared to the SOX. And you can see there's a very, very, very substantial gap both on a 3-year and on a 6-month basis between your broader indices and your semiconductors. Right now, the AI story is about semiconductors, and they are flying. And you can see if there's going to be a bubble, it's going to be there, all right? And less so in the broad indices. So I think that the first sign of comfort that you should get is that the broad indices are much more subdued results than the specific semiconductors. Gold this year, -7, Bitcoin -33. If you bought into the story that the US dollar was collapsing last year and you panicked and sold your dollar investments in order to buy gold and Bitcoin, then you're seriously worse off. Bitcoin over the last 3 years, -11. Gold over the last 3 years is 110%. Please compare that to NASDAQ at 103. Very similar returns over 3 years. Over 5 years, NASDAQ is definite winner. I'd much, if I'm going to have something in the portfolio that is as volatile as gold, I'd prefer to have NASDAQ. And that's been our philosophy for more than 10 years. So whilst gold had a fantastic run through the second half of 2024 and 2025, it has underperformed equities over a longer term. So if you're going to protect yourself from inflation, rather have equities. That's something I'm going to be repeating a few times. Okay, so the main takeaway from this slide is there's a very big difference between the semiconductors and the main broad index as a source of comfort. Okay, if there's a bubble in AI, then there's a bubble in tech. If there's a bubble in tech, then there would be reflected in the NASDAQ, all right? One way to identify a bubble is to look at valuations. The main valuation is price metric that we refer to is price over earnings. So you take the market value of the company divided by their earnings, and you get a multiple, which reflects the number of years worth of earnings that are expressed in the price. It's far from a perfect measure. It's not a good measure for short-term trading strategies at all. But it is one measure which will help us identify if there's irrational valuations, okay? So let's compare the NASDAQ today. And normally when I present multiples, I'm normally talking about the S&P. Here we're talking specifically about NASDAQ and tech. So if there's going to be a problem, it's going to be here. So let's see, the multiples today are 33, which is high. Okay, but tech is always trading high compared to traditional companies. Why? Because their profit margin and their growth is much stronger. So you're always going to pay a premium for tech. All right, but 33, which is not a low number by historic, is nowhere near the 70 to 80 from the 99-2000 dot-com bubble. Nowhere near. More so, the balance sheets, which are not reflected in this number, are stronger today than they were back then. And more importantly, the internet bubble or the dot-com bubble, they didn't know how to measure success because none of the companies had sales. They didn't have revenue models. They were measuring clicks and click-through and internet site traffic as a way to reflect value. Today, we're using financial metrics. We're using profit. So we know which of these AI companies, at least the bigger ones, are making real money and which are selling fantasies. So I think that that's a very strong source of comfort. Another point I'd like to point out, if you were the unluckiest investor and you bought NASDAQ the day before the dot-com bubble crashed, which I think was the 1st of March 2000, if you were the most unlucky guy, right, and you held it till today, your return would have been 740% or over 8% annualized, okay? You needed to be very patient. It took NASDAQ a long time to recover from the dot-com bubble. It took a long time, but in the end, long-term investing paid off handsomely. Okay, so that's another source of comfort. Now, we all have smartphones, and some of us have notifications set on, and you get a notification saying the market is at a new peak. S&P 500 is at a new peak. The word peak is terrible because what comes after a peak? You expect that downhill side that comes to come after the peak. But the reality is the S&P 500 as an index has broken its peak 7,310 times. Okay, it was launched in 1957 at 44. You can Google why 44, and it is now on the weekend. It was 7,354, and it had a negative day yesterday. So, but still, every single little dot here that you see on this graph is a new peak, and you see this long-term trend of the S&P 500 going up over time. Now, when you zoom out far, these downs in the dot-com bubble here and the 2008 financial crisis here, they don't look like much, but at the time they were quite significant. So we need to ask ourselves this fundamental question: why does the index keep going up? Why is it a realistic expectation for it to keep going up? I showed you the S&P 500 has done 75% over the last 3 years. That's a big number. So it's natural to be concerned, but let's focus on the expectation. Why do we expect the S&P to continue to go up? Like a football league, every year you kick out the worst 3 teams that get relegated, and you allow the 3 rising stars from the league below. The S&P 500 does a similar thing. Every year or 6 months, depending on who's tracking it, they will add in the winners and kick out the losers based on the index rules. And this provides a structural way that the S&P 500 constantly is reflecting the best companies in the market. And it changes dramatically over time. The S&P 500 today is very different to the S&P 500 30 years ago, where you have General Electric and Kodak and other companies like that. Today, it's very much tech heavy. We've had concentration in the past, where the top 10 companies have always been a significant number. Today, they're higher at about 35%, where we're normally around 20%. Why else does the index keep going up? We have innovation. Companies innovate, they get better, they get more efficient, they make more money. Population growth, more people buying your products, more people working, saving, earning, investing, buying products. Population growth. Economic growth, as the economy grows, companies sell more people can buy, and it's a very healthy loop, which has allowed America to become the largest, the wealthiest country. Well, at least the capital markets are the largest, not per capita, they're not the wealthiest. Another underappreciated reason for growth in the market is inflation. So companies increase their prices with inflation, sometimes even more than official inflation, and blame inflation. And that filters through to the profitability and through the share price. So you embedded in that index is some inflation protection, and that adds up over time, particularly the last few years. And of course, more and more money is being invested in the United States as it continues to show that it is the strongest economy in the world. So roughly 25% of every pension fund that you can think of, whether it's Israeli, Japanese, Norwegian, Arab sovereign funds, South African, almost 20, on average, 25% of those monies are finding their way into the S&P 500, and the index is growing as a result. So as savers around the world save, that money goes back into the American economy. So all of this should give you comfort that it's natural to expect the index to grow up over time, to go up over time. But it's not in straight lines. This is one of my favorite graphs to explain market volatility. The bars represent calendar years from 1990 to 2026. And immediately you see more bars above the index, the zero line, the axis. Okay, so more positive years than negative years by far. But that's not the interesting bit. The interesting bit is the intra-year drawdown. Every single year has its drawdown, peak to trough, negative few months. Some bigger, some smaller, but every year. And the reasons change. This year it was the Iran war. Last year, or so far, last year it was tariffs. Every year there's a different reason for the sell-off. And this is part and parcel of equity investing. I always marvel in my job here how often I probably get 50 questions on why the market is going down for every one question or why the market is going up. Okay, literally 50 to 1. When the market goes down, everyone's asking for a reason. Why? And you don't always know the reason. The financial press will attach a reason, whether it's true or not is debatable. But the market is the market. It's meant to go down. It's healthy. It's healthy when it occasionally sells off. So bear that in mind. Another source of comfort about long-term investing. Let's talk about AI a little bit deeper now. So social media opinions vary. I've been sent a lot of videos with interviews with experts of various types, and some of them are just pessimistic and some of them are just downright apocalyptic. Okay, they say that it's going to be worse than 2000, that there's a bubble in AI and a bubble in big tech, and it's pretty scary stuff, and some of them are quite articulate in what they believe. You got to understand that everyone has an agenda. So one of the interviews I got sent the most was by an American hedge fund manager, and he has a bearish strategy. He has a contrarian strategy. So he's kind of selling himself. I have no doubt that that's paid PR, and that's his agenda, okay? To scare everyone into buying but if you drill down into his funds on the public, whatever's availably public, he does hold Apple and Google and other companies like that, even though he's so negative when he's interviewed. So there's a lot of scary stuff out there, and don't mix up the AI potential bubble with the general market bubble, okay? So right now, I believe there's no general market bubble. There may or may not be. There's a bubble in the specific AI stocks, but as I showed you right now, that's semiconductors, which are only a small part of the general indices, and we should get some serious comfort from that. There are clearly risks, but the macro trend is overwhelmingly positive. Every one of us is using AI to a greater or lesser extent. And it's monetized. Unlike the 1999, 2000, where they didn't know how to make money yet on internet, AI is already monetized, from the simplest $20 a month subscription to the engineers we're using AI a lot. I've tokenized it, and you buy tokens for your usage, and they could be spending hundreds of thousands of dollars per year on tokens per engineer. And then there's the Google model, which is to monetize your usage of AI through their media channels. So it's already being used, and it's already being monetized right now as we speak. And we suspect that one of the biggest buyers of AI services is going to be governments, not for civil servants. I seriously think civil servants are going to be the absolute last people to adopt AI, but governments are going to be buying AI very heavily from a military and strategic point of view. So there's going to be a lot of government investment there. Why? Because they have to. So yes, there's a lot of hype and AI washing. Sometimes you read about a company laying off staff and blaming AI, but actually AI has got nothing to do with it. We invest in companies, not technology. It's management's job to evolve as the technology evolves and to make money. And again, expect the volatility. It's part and parcel with investing in growth areas. Another source of comfort is the overall money that is being made by US companies. As a general, across the S&P 500, companies are making more money than ever before. This is earnings per share for 2026 estimate is a huge jump from last year. Yes, a lot of that's coming from semiconductors, but they're actually making money as opposed to just selling stories, and I'm going to show you in a second. But this is roughly 3 times the amount of money that was made in 2016. So there's some serious profits coming through to justify the higher values of the stock market. This is a piece by Goldman Sachs, and they try to analyze the breadth of earnings growth. So they say the median would be not weighted according to your Mag 7. Your median is 12.9% quarterly annualized growth quarter on quarter of earnings. So that's a very strong number. And if you strip out from the S&P 500, you strip out the Magnificent Seven and Infotech, you've still got a 10.2% growth in earnings in Q1 26 compared to the long-term average of 6.5. So there's a strong earnings story going on. Now, I get asked very, very often, too many investors and too many clients associate AI with big tech, okay? The only real overlap there is NVIDIA and a little bit of Google, or part of Google, okay? But let's analyze the performance just to illustrate the point. So forgive these funny-looking boxes here. I've got from the 1st of January or 31 December 25 to the 6th of July 26, so up until basically yesterday, SOX is at 93%. Remember, I showed you 113% to the end of June. So it lost quite a lot of money in the first week of July. MAGS, the Magnificent Seven, was flat. The Magnificent Seven was flat. The Magnificent Seven underperformed the broader index, and that's very interesting, and that's contrary to what people expect. And the S&P was up 10. But more interestingly for me, when this sort of recent sell-off in AI started, okay, SOX, which was on about the third week of June, SOX was down 11%, so that's semiconductors down 11%. NASDAQ was down only 2%, okay, and the S&P was up about 1%, and the Magnificent Seven were up 3.3%. So it was almost like a flight to quality where money flowed out of the very expensive semiconductors and went into Mag 7, okay? That is the exact opposite of what many investors have said to me when they assume that the app where Apple, Amazon, Tesla, are overvalued because of AI. So that should be another source of comfort. Just to remind some of the names inside SOX, Micron, Broadcom, yes, NVIDIA, that's the only overlap, Advanced Micro Devices, Taiwan Semiconductor, Intel, KLA. So many of those names you've never even heard of. So that's another source of comfort. Some clear AI winners, all right? The biggest one is probably Micron. A year ago, exactly a year ago, 10th of July, 2025, its share price was 120. And Micron is in that SOX index, and it is in the general index as well. Just shy of a year later, 25th of June, it peaked at 1,200. So that's a 10x. 10x is 1,000% gain in share price till that date. Yet the price earnings multiple only went up from 22 to 27. Okay, that's a 25%. So if your price goes up 1,000% and your earnings multiple goes up only 25%, that means your profit has gone up nearly 40 times. Micron were selling chips like they've never sold it before. They couldn't make them fast enough, and their profit went up 40-fold. Okay, then the sell-off started, and Micron share price went down about 25%. And now you can buy Micron for the exact same price multiple as you did a year ago, even though the price is 8 times more than it was a year ago. So that if the whole market was like that, then you would have absolutely nothing to worry about in the AI space. But the problem is that it's not all like that. But this is a clear winner and in the space. Broadcom, not as strong a story. Share price a year ago, 278, with a multiple of 70. And on the 5th of July, share price, the share price was 360 with a multiple of 55. So that also shows that there's significant profits coming through in Broadcom. AI spending is real, just to re-emphasize the point that this is not 1999. 384 billion is being spent on AI and AI related, whether it's data centers, chips, etc., software security. This is a big number, and it's affecting, and it should be a source of comfort, not a source of concern. Another surprising data point is the broad return per sector of the S&P 500. If I would have said to you, what sector was the best performing, having shown you what stocks did at, plus 100%, if I asked you what was the best sector in the S&P 500, you probably would have told me tech. But up until yesterday, tech was the third best. Energy, because of the spike in oil prices, energy companies were the second best, and industrials were actually the strongest. So this should be another source of comfort around the S&P 500, that it's not all AI. Ratios, price earnings multiples across the index divided by their size. So your large cap, which is not just the Magnificent Seven, is at 23 times, which is historically a little high. And then your mid cap and small cap at 18 or 17, that's more reasonable. But I want to bring your attention to how these multiples have come down in 2026. So the multiple has come down and the stock price has gone up. Just like that Broadcom example, that means there's been substantial profit. More profit than expected has come through, and that's why you've got multiple contraction with rising share prices. So another source of comfort for you. Goldman Sachs. So I follow Goldman Sachs's investment strategy group. Their forecast for the remainder of the year, they assign a 25% probability to the good case, which means the S&P 500 will go up another 13%, which will finish the year around 23%. Okay, their central case, the base case, which they assign a 55% probability, is that the S&P will only go up another 3% this year and finish around 12 or 13%. And they assign a 20% probability to the bad case. But even if the bad case happens, they say it's going to be 10% down from now, with a small loss on a year-to-date basis. Okay. The takeaway from this is that there's a 55% plus 25, according to Goldman Sachs, of course. That's an 80% probability that equities will be higher than at the end of the year than they are today. Obviously, it's just an estimation, but that should be a strong source of comfort. And I actually agree. I agree with Goldman on this one. I would say the probability of the equity index finishing higher than it is today is in the region of 80%. So that should be another source of comfort for equity investors. Within the equity world, there's some crazy high irrational names. Sound High AI, they do AI voice recognition, no profit, expected revenue 240 million, market cap 2.8 billion. They're trading at 11 times gross revenue, not 11 times profit, 11 times gross revenue, which is an insane valuation. It's not in any major index right now, but it's they have to produce some serious growth to justify that share price. These are the irrational valuations. CrowdStrike, a much bigger company, 197 billion market cap. It's actually 0.5% of NASDAQ. In my mind, hugely overvalued, but one never knows. If they're successful at selling cybersecurity services, maybe they'll justify that very high share price. Another one is C3 AI. They do enterprise AI, also, by my mind, a ridiculous valuation. Speaking of ridiculous valuations, SpaceX, some clients asked us if we should buy it, and the answer was no. The share price has shot up of late. It's been around since 2002. They have a product called Starlink, which we can understand, but they also have this vision of data centers in space, which we can't understand. And we certainly can't understand the economics behind it. So we're not big fans of SpaceX. When you look at the 10 largest IPOs in history, here the names are at the bottom. 1 year later, they're all lower than their IPO price, and we expect SpaceX to do the same. It's going to take a while for SpaceX to justify itself. Don't worry about SpaceX getting into the indices like NASDAQ and S&P. First, you need a profit history. And secondly, it's not just market cap weighted. Those indices have float adjusted market cap. So in the S&P 500, because the float, which is the shares available to the public, is so small in SpaceX, it'll grow over time, but right now it's about 5%. Because that float is so small, it's going to place a tiny percent, a fraction of a percent in the indices when it actually gets there. So we don't have to worry about SpaceX taking up too much space in the index. Okay, moving on to broad macro issues globally, or at least, the US, which the US drives the world globally. Inflation is a source of concern. It is higher than it should be. And it's not what you think. Everybody thinks it's because of energy prices, because of the Iran war. Actually, no. The inflation was there in January before the war, and it's in services inflation, which is what bothers us. The energy inflation is already starting to taper off. The AI effect on economic growth and the labor market in the long term, right? The long term, not the short term. So that's just an unknown. Nobody knows what that's going to be. If it's a significant impact, for better or for worse, we'll have to wait and see in time. No one has a good answer for that right now. And regime change at the Federal Reserve. That is something we're going to discuss in a second. So firstly, economic growth in the USA is absolutely fine. I actually expected it to be even higher than that, but it's a huge economy. So 3.3% is a very big number. Inflation. US consumer price inflation has risen by an average of 4.5% over the last 5 years for a total of more than 24%. Core services inflation is currently at 3.85. That is just way too high. Very, very, very small part of that is energy related. The Federal Reserve have a inflation target of 2%, which is just a myth. We haven't been close to it for a long time. And so why is there inflation? Okay, there's the wealth effect. In the United States, there's a lot of people who can afford. So even if your goods and services are expensive, there's a lot of people who can afford them, and the prices stay high. If no one can afford it, then the price would come down. There's a fiscal effect. Governments are running at deficits. They're spending more than they're bringing in. That is inflationary. There's a monetary policy effect. That means interest rates are lower than where they should be. That is inflationary. The AI capex effect, if you're spending $400 billion on something, that's almost what a government would spend, not an industry. So that has going to be inflationary. And then there's inflation all over the world. So the United States is importing inflation. So all of that is a little bit concerning. But for me, it justifies increasing your equity percentage because inflation doesn't seem to be coming down meaningfully anytime soon. Just to illustrate the wealth effect, I was sent this by my colleague, Shmulik. The 2018, the amount wagered on sports in the United States, 6.6 billion. 2025, which is before the World Cup, 165 billion. So that just shows you the scale of the wealth in the United States. A new broom sweeping clean at the Fed. Okay, so we've got a new chairman of the Federal Reserve. His name's Kevin Walsh. And he does not believe in two modern foundation principles at the Fed. One is forward guidance. Since 2003, under Greenspan, the Federal Reserve has given forward guidance to the market about their intentions. It hasn't been 100% perfect, but it definitely helps the market plan ahead, which reduces the possibility of surprises, except for 2008. But it is a signal, okay? And then in 2007, it started what's called balance sheet intervention or quantitative easing, when the Federal Reserve uses its balance sheet to buy bonds and create stability. When sometimes we see the equity market sell off, but the actual source of that is some sort of panic in the bond market. And then the Federal Reserve would intervene, create stability in the bond market, and then you would see a V-shaped recovery in the stock market. So most of the crises we've had since recovering from the global financial crisis in 2008, most of them have been V-shaped recoveries because the government intervened to create stability in the bond market. Right now, so Kevin doesn't control the Federal Reserve. It's a committee with voting. But if he's influencing, then that may affect what we can expect. We may have deeper sell-offs because if they don't intervene to create comfort, then we'll have a deeper sell-off. And we may have a slower recovery. May have, not necessarily. I think at a certain point, if some sort of crisis started developing, then the Fed will intervene because that's what we've got used to since 2008. But it is a source of concern for me. The $40 trillion United States debt gorilla, I mentioned this at every one of my webinars. It just grows and grows and grows and grows. And it's a reason why you need to be invested in equities and less in bonds. The US government is not going to repay this. It's growing all the time. Therefore, we're going to be in an inflationary environment, in my opinion. The more money in the system through this debt, the more asset prices will reprice. So you want to have equity, even with the volatility that equities may bring. Short-term rates at the beginning of the year were expected to go down. They're now flat, expected to go up later in the year. How does this affect you? If you have dollar deposits at the bank and you're deciding how long to close it for, sorry, close it is an Israeli word for a fixed deposit, rather close it for 2 months or 3 months rather than 1 year, because interest rates will go up in the short term. Okay, moving on to Israel. So the Israeli economy shrank in Q1 by 3.8% because of the war. Inflation ticked up at 1.9%, which is very, very low. And the unemployment was a very low 2.7%. I do believe that excludes the Haredi world. So still very, very strong numbers given our reality. Diving down into the Israeli market sectors, so Tel Aviv 35, which is what I call the Dow Jones of Israel, is up 10.9%. The Tel Aviv 125, which is our main benchmark, is up 8.3%. And it was dragged down by oil and gas, some banks, and property. Okay. Small and medium size did nicely at 8.7. Insurance companies have done very, very well. They're very, very profitable, making way too much money, in my opinion. But very strong performance from the insurance. We think insurance companies are a little bit expensive right now. Oil and gas, in Israel, it's mainly the gas. It's negative because of the war. The government shut down all the gas industry. Not a good idea to operate gas while missiles are landing on your head. The tech, Israel tech closely correlates to NASDAQ. We prefer more NASDAQ than local tech, but we do have both. And the property market is showing signs of strain, particularly the highly levered developers. Those are, they're definitely not selling the properties that they thought they would sell at the prices they thought they would sell. So there is some stress coming through there. Israel interest rate expectations. I apologize for the Hebrew graph. All this is saying is the rest of the world is expected to increase rates, while Israel is expected to decrease rates. Some of you will ask that will help the shekel weaken a little bit. I don't think so. Maybe a little bit, but the shekel doesn't normally respond very strongly to interest rate differentials because there aren't that many people doing a carry trade into shekels. But it might help weaken the shekel a little bit. The strong shekel, which we've all been surprised just how strong it can get, even though we're not surprised that it's strong, but when it hit 2.79, I think that was that was a bit of a surprise. The consequences are quite broad, especially for small tech. So I don't think Apple and Google and Nvidia and some of the big tech companies that operate large offices in Israel, I don't think they're that sensitive to paying more for their engineers. Give or take $50 million for them is not a big number. But it also affects, but small tech is much more vulnerable, right? Startups who have to hire engineers and pay them shekel salaries while they raise dollars. That has a negative impact. Also, taxes and revenue from our exports is in dollars. So there's some negative consequences. And therefore, we think that the Bank of Israel will intervene at approximately 2.9. And we expect the dollar shekel exchange rate to bounce around between 2.9 and 3.1. Stock market valuations in Israel are, in general, slightly high, which increases the chance of volatility. Doesn't mean you must sell and wait for better days. It just means we must be more patient. Insurance sector is expensive, but they're very profitable. Biotech is expensive. We're not huge fans of the property developers right now. Bond spreads are tight, but still a nice, comfortable excess over what the banks will give you for cash. High-tech capital raising is pretty strong, I believe, and official inflation trending down. My crystal ball in conclusions, the broad market in the being the S&P is not in bubble territory. It's not. However, there are areas of tension between fundamentals and valuations, particularly in chip manufacturing. If you want to avoid the AI story altogether, okay, then just don't buy indices like SOX or SMH. But be aware that AI story is inside a lot of other things, but I'm quite comfortable that we're not in bubble territory in the broad market indices. I'm more of an inflationary boom believer than a stagflation. Stagflation is high growth, high inflation. Sorry, stagflation is low growth, high inflation. Inflationary boom is high growth, high inflation. So I believe that we're in inflationary boom, which should be good for equities. I believe the space sector is in the bubble, and the valuations are unrealistic there, or hard to understand, or too difficult to understand. Politically, it's very difficult to predict Iran outcomes. I wrote this on Sunday, and this morning Trump made a pretty outrageous comment about the ceasefire being over, and he called the Iranians scumbags. I think that's just posturing. I can't see us going back to war, but you never know, and it's a real risk. Inflation is sticky in dollars, but trending down in shekel. We expect the 10-year rate, which affects bonds, to trade between 4.2 and 4.6, which means we can be relaxed about bonds and not panic. I'm more of the view that there's more risk to higher rates on the long term than some of my colleagues, but it's by no means clear to anyone where it'll go. I'm more of a bond bear than a bond bull. Short-term rates are no longer trending down, and we expect one increase later in the year. Conclusions: be at the maximum equity allocation you can tolerate should there be a substantial sell-off. Okay, when the AI sell-off happens, just like the last 2 weeks, the AI stocks, the chip manufacturers, are far worse. Remember what I showed you. The SOX is down -11, while your Magnificent 7 is up 3.3 over the last 2 weeks of a sell-off. Hopefully, that would be what will be repeated. Be disciplined about your asset allocation. As always, the fundamentals are there to continue investing. Bonds do offer anchor value. Israeli market valuations are a little bit high, so be patient. Don't try to time the market. I mentioned that, and I mentioned that about the currency, and stay invested no matter what happens. Manage your risk before. Okay, some questions that were received on registration. How is the outlook for Israeli companies? We said the Israeli stock market is a little bit high, but the economic outlook is going to be strong. So ultimately, the stock market will benefit. How do we best participate in the future growth of the Israeli economy? Through the Tel Aviv stock market. Overseas buyers often want to invest in Israeli high-tech startup or something like that, which is exceptionally risky thing to do. I think there's enough volatility and liquidity in the Tel Aviv stock market to give you most of the exposure you're looking for here. Where can my money generate more income? Okay, so this is a discussion you need to have with your relationship manager. I prefer to be more growth orientated, and when I need cash, sell some of those investments, because when you're too income focused, then you're going to be too conservative and your money won't keep up with inflation. The sterling, there were lots of questions through registration about the sterling and shekel exchange rate. Just like the dollar, we think that it's going to remain strong, so remain in the 3.8 to 4.10 range against the pound. My long-term outlook for the pound is weak. My long-term outlook for the shekel is stronger. So if you see spikes in the rate, which may happen both on the dollar or on the sterling, if you see spikes, don't be greedy, sell a chunk and buy some shekels and try to achieve some sort of average. Okay, don't hold on for 4.5 to the pound or 3.5 to the dollar. I think that's a little bit too optimistic. How will Israel's energy dependency affect the market? I assume you're talking about oil because Israel is actually independent when it comes to gas. So oil we import from countries like Kazakhstan, Uzbekistan, and Nigeria. So politically, those countries are not affected, aren't affected by pressures, global pressures. And I assume this question means what is the high oil price on the Israeli market? Just like anyone else, high oil prices will affect or a drag on growth. Are AI companies solid? No, I would never use the word solid and AI in the same sentence. But do they have more room for growth? I do, but yes, I think that there is still more growth to come in the AI story, but it's not going to happen in straight lines. We're going to have volatility, and therefore AI is not solid. Okay, let me have a look and see if any questions came in during the chat. Ooh, I can't hear. There's an echo. Okay. All right. So thank you, everyone, for the time. Hope it was interesting. We'll see you in September. Thank you.